Hello, everyone, and welcome to the Trading the Most Predictable and Profitable Market for Daily Income workshop. I want to first thank each and every one of you for taking your valuable time out of your busy schedule to join me today. I really do appreciate it, and I see lots of familiar names from literally all over the world here today, and I'm really glad to see you here. So thank you again, okay? The anticipation has been extremely high due to all the calls and emails that I've gotten over the past week. It's really been incredible. So I promise I'll give you everything I've got, okay? Boy, we've certainly got a full house today, right at room capacity of about 1,000 people. Again, I wish there was a way to get more in, but I just can't do it at this time. Now again, I've got a lot of great actionable day trading strategies that I want to show you today that you can literally start using tomorrow if you want. So I'm going to keep this introduction as short as possible so I can get right to the meat of it. Now, before I start, I want to make sure that everyone here can hear me all right. So if you can hear me, just do me a favor and send me a quick note using the box below the screen. I want to make sure, absolute sure, that there are no problems before I begin, okay? So, all right, I'm seeing a bunch of people type in. Okay, good, okay. Everyone's saying that you can hear me just fine, the screen's fine, nothing's blinking, everything's good, okay. So, okay, let me now give you just a real quick bio of who I am, where I'm coming from, my experience, and where I've been as a trader, so you have a better understanding of me, okay? Now, as most of you already know, my name's Todd Mitchell. I'm the founder and CEO of Trading Concepts, and I've been a successful full-time trader now for over 26 years. I've been reading about, studying, and researching the markets back in 1986. Okay, so that's when I began. Back in 86 is when I began learning, while I was still in college. Then, in 1988, I started to actively trade the markets with real money. And again, at this time, I was still in college. Now, my interest, which quickly led into fascination in the futures and the stock market, began when I used to manually update my father's charts on a daily basis. Then, in 1990, when I graduated from college, I decided to trade full-time because I had seen firsthand how much money could be made from trading. And luckily, I really haven't had a job other than trading since that time. And then after a few successful trading years following college, once I tweaked and further perfected my trading strategies and methodologies, I decided to use my knowledge and experience to launch Trading Concepts in 1994. So I could teach aspiring traders just like you, and since that time, I've taught literally tens of thousands of traders from all over the world like you how to become more consistently profitable. Okay? I've also written a book called Trading Made Easy, and it can be found on Amazon. And I've also been featured in the book What It Takes: The Secrets of Becoming a Successful Trader. Interviews with 9 Trading Masters by Eddie Z or Russ Hazelcorn, which can also be found on Amazon. And finally, I've been married to my beautiful wife Karen for 19 years, and we have 2 wonderful children, Christian, who'll be 10 soon, and Olivia, who just turned 14. All right, enough about me. Let's get right into what you came here for. So grab a pen and paper and get ready to take some notes. Now, I love this stuff, and I think you will too. Oh yeah, just one more thing before I begin. I want to quickly go through the mandated government disclaimer and to summarize it for you quickly. It basically tells you very common sense things like don't trade with money that you can't afford to lose, and only use risk capital when you are swing trading stocks or any other type of assets, day trading such as futures, currencies, ETFs, or options. In addition, if you use margin, you can lose more than what you originally started with because margin is leverage. So please take this into consideration. Also, it's very difficult psychologically to make money when you're trading with money that you can't afford to lose. So please avoid doing that, okay? You should paper trade when you first start learning any type of new trading method, and then just build up your position size slowly, starting with very small share size or contract size if possible. All right, now let's get right into the meat of trading the most predictable and profitable market for daily income workshop, okay? I'm going to give you a lot of good stuff here. So let me get you what you came here for. Let's begin. All right, so what I'm going to talk to you today about are, first, the best markets to trade for daily income, okay? Number two, I want to go through the most profitable and the most predictable times during the day in which to produce this daily income. And perhaps more importantly, what times to avoid trading altogether. Third thing I want to talk to you about is there are about 3 everyday mistakes preventing more than 80% of traders from ever making money in the markets. And then I'm going to finally go through with you the simple 4-step process for boosting your trading profits almost immediately, right out of the gate, okay? The markets I'm referring to, right, are the E-mini futures contracts. I'm sure all of you have heard of what the E-mini futures are, but I'm going to go through them real quickly and give you the advantages as to why you should seriously be trading them if you're not already, okay? Number one, the E-mini futures track the most popular broad-based stock index benchmarks in the financial world, right? They were launched between 1997 and 2005, right? And by far, they are among the fastest growing products in the entire industry. All right, and all E-mini futures contracts are traded completely 100% electronically, pretty much virtually 24 hours a day, and they trade at 1/5 the size of their standard counterparts. And the rapid price changes associated with E-mini futures create continuous trading opportunities. Let me give you a bunch of reasons why you need to be day trading the E-mini futures. Okay, first, they're highly liquid, very active, and they're volatile markets with wide enough daily trading ranges for plenty of trading opportunities that you'll see, okay? And you'll be able to profit, obviously, no matter which way the market moves up or down, just like in any other market. But real importantly here, like I mentioned in the last slide, they trade electronically virtually 24 hours a day, okay? And the use of leverage provides you, the retail trader, with more flexibility, right? I mean, you can trade for as low as $500 per contract. Okay, so for those of you that are trading the Forex market and if you think the Forex market's the only thing around that you can trade with high leverage, you're absolutely wrong. The E-mini futures are really the place to be, and I'll get into that in more detail in just a second here. Okay, and you'll be able to easily participate in broad market moves by just trading one market, right? One market, one chart, instead of trading individual stocks and looking at just tons of charts trying to decide what you want to trade. Again, you can easily participate in the general market moves by just looking at one chart. Okay? A simple 2-point move can be up to a 10% return on investment. Okay? And you know the big thing here, and for those of you that are in love with the Forex market and feel that the Forex market is the only market for you because of your small account size, you're absolutely wrong. You can trade the E-minis with an account size of $2,500 or less. Okay, I mean I know a couple firms that'll allow you to start up an account with only $700. Okay, so lots of advantages here. Let's get into some more advantage. Okay, for those of you that prefer to trade stocks or ETFs, let me show you why you need to be seriously considering trading the E-minis for your daily income here, okay? Obviously, trading the E-mini futures is much more efficient use of your capital because of the leverage, right? You can put up a fraction of the amount of margin. Now, this third one is huge here. If you're going to day trade stocks or ETFs, you need $25,000 in your account, okay? But to day trade futures, again, you can get in for as little as $1,500. Even again, there's a couple firms that allow you to trade for $700-800. Start an account with that little amount, but I would suggest $1,500 minimum. But again, that's a lot less than $25,000 that a lot of stock and ETF traders use. Okay, so you can get started with a whole lot less. And like I mentioned in the last slide, this is a huge one. You participate in broad market moves by trading one market, right? One market, one chart. Makes it much more simple. And this here is for those of you that like the Forex market. I mean, the Forex market's fine, but again, if you're planning to day trade or trade a market for daily income, look at day trading E-minis are much more predictable on the smaller time frames, and the intraday price movements are much smoother. Okay, I've done them both, and by far, like I just said, the E-minis are much more predictable in nature, and the movements, the small intraday movements, are much smoother and like I said, more predictable. Okay, so smoother movements and a much more predictability in the smaller time frames. Okay, and you've got very tight bid-ask spreads. I mean, so compared to trading the Forex market, the E-mini futures bid-ask spread is only 1 tick, while trading some of the major Forex currency pairs may be up to 4 to 5 pips. That's a big difference. A big difference. Okay? Again, the Forex market's just fine in trading off the bigger time frames. However, like I said, in my own personal trading experience, the E-mini futures are much more predictable in nature. Much more predictable. Let's talk briefly about the 4 most popular E-mini futures contracts, okay? We'll go into a little bit more detail in the next few slides, but the first one here, the E-mini S&P 500 market, right? E-mini S&P 500 market, symbol ES. Again, we'll get into that in the next couple slides. Then you've got the E-mini NASDAQ, right? The NQs. The third one, E-mini Dow, right? The YM. And then you've got, so there's really four popular ones to day trade, right? The Russell 2000 Index, and I want to jump into each one of them real quick and show you a chart and give you the specifics on each if you're not already familiar with them, okay? Again, the E-mini S&P 500, the symbol is ES, right? It's traded on the CME, right? Chicago Mercantile Exchange. The tick sizes, right? Each minimum price fluctuation is 25 cents on the index points, and each tick size is worth $12.50 per contract. The contracts, so since there's 4 ticks and 1 full point, you've got $50 for a full point. Okay, this is what the chart looks like, right? They all look the same, right? A chart's a chart. It's all price action, all does the same thing. So the E-mini S&P 500 futures, right? Again, this is the world's most actively traded stock index futures contract with over 2.2 million contracts traded on average per day. So this is the big one, okay? I've traded this since it was introduced back in the fall of 1997, but of course I started, trading the S&Ps back in the spring of 1988. So I've been, trading this market for a long time. Then of course you've got the E-mini NASDAQ 100. Okay, E-mini NASDAQ 100, the symbol is NQ. Again, this is traded at the CME, the Chicago Mercantile Exchange, right? This trades about 310,000 contracts traded on an average day, okay? 310,000 compared to 2.2 million in the E-mini S&P 500. Big difference there. So a tick size, right? Again, a minimum price fluctuation is 25 cents, and each one of those, right? $5 per contract. So $5 a full point. That's how it trades. All right. Then the third one you have here is the E-mini Dow, symbol YM. Again, that trades on the CME, the Chicago Mercantile Exchange. Right. When one index point, it's $5 per contract. Right. This tracks the Dow. Right. This is the actual Dow 30 stocks. It's about 130,000 contracts traded on an average day. All right, again, all charts, they all look the same, but these 4 markets by far are the best for that daily income. The last one I want to talk about real briefly is the Russell 2000 Index, right? That symbol is TF, and that's traded on the ICE exchange. Now remember, if you just type in TF or YM, ES, or NQ, it's not going to pop up. If you want the continuous contract, put the @ sign TF, and that'll pop it up. As long as you get live data feed on the ICE exchange, or if you put the @ sign ES, you can get the E-mini S&P 500. If you throw a D there, that's for day session only. So
Tick size is 10-cent increments, right? 10 cents, $5 per contract, and that's how it trades. So those are the 4 main E-mini futures contracts, right? The E-mini S&P 500, the E-mini NASDAQ, the YM for the Dow, and then of course you've got the Russell 2000. And again, these 4 futures contracts are by far the best markets to trade in order to produce that daily income that I'm talking about. So what I want to get into now, okay, is the most profitable and predictable times to produce daily income and what times to avoid trading, okay? So let's jump right into it. All right, let's get right into the most profitable and predictable times during the day, okay? And this is really important for you to understand, okay? You do not have to be a slave to your computer all day long. You certainly don't, okay? I don't sit and stare at my screen all day, and you certainly don't either, okay? There are, and you have to realize this is real important. Most people don't understand this. I mean, there are certain times during the day where the markets become very, very predictable. And I'm going to show you right here exactly what times these are and how to successfully trade those times, okay? These times only consist of roughly 2 to 3 hours during the day, right? I've got many, many, many students that make a full-time living for only spending 45 minutes to an hour and a half a day concentrating on what I'm going to show you right here. So again, and I want to make this point real clear, you do not need to be glued to your computer all day. That's very important to understand. A big huge myth and misconception is that if you're going to day trade, okay, you need to be sitting there all day, and that is absolutely not the case, okay? There's only a few certain times during the day where the market becomes extremely predictable, and there are certain times during the day where you don't even want to pay attention to the market, okay? I'm going to talk about the morning action times right here. Then you've got the post-lunch, afternoon move, right? So we got the post-lunch in and around 1, between 1 and 2. Then the afternoon move, something typically occurs in and around 2 o'clock and in and around 3 o'clock. So let's get right into that, okay? First, let's talk about that morning action, okay? That morning action is precisely between 10:15 and 10:45 a.m. Eastern Standard Time, okay? So what we're expecting, CT stands for counter trend, right? So we're expecting some type of counter trend move within the first 45 to 60 minutes of trading. So that puts us right, market opens up at 9:30, right? 9:30. So 45 minutes into the open at 10:45, somewhere in between 10:15 and 10:45 in the morning, we're expecting some type of move against what the market has done in that first 45 minutes, okay? I'm going to show you examples of this morning action and exactly what I'm talking about. So then you get into doldrums during the day, okay? The doldrums really consist from about 11:25 roughly to 1 o'clock, 12:45. You don't even want to touch the market at those times, okay? Go do something else. Market typically doesn't do a whole lot. Now, when the market, after, I call this the post-lunch move. So but roughly between 1 o'clock and 2 o'clock Eastern Standard Time, I'm expecting a resumption of the day's trend if. So number one, so if the trend is up and the market is trading down off the high of the day, I'm expecting some type of resumption back up towards that high. It's that simple. And number two, right, the opposite of if the trend is up, well, the opposite of that is if the trend is down. If the trend is down and the market is trading up off that low, I'm expecting some type of resumption to the downside. So real simple, okay? So morning action, let's say it's about 10:30 right in here, okay? I'm expecting the market to make some type of move up off that low because the first 45-minute trend is down. Over here, so if the market is, trending up and we're trading down off that high, I would expect a resumption back up towards that high. That's simple. The trend is down and it's near, between 1 and 2 o'clock and it's up off that low and the trend is down, I'm expecting some type of resumption back down. It's that simple. Don't make it any more complicated. It's that simple. So let's take a look at a chart. right? This is the morning action, right? The market opens up right here on this bar. That's the open, trades up, and comes down. Now this shaded area in here is between 10:15, right? 10:15 and 10:45 in the morning. Look at the market based. It bottomed out and ran up, right? Isn't that a counter trend move? Isn't that a move against the current trend? Because as you can see here, the trend is down. So between 10:15 and 10:45, the market bounced up, and that's what you're typically expecting, okay? Let's take a look at the other time. We're looking at between 1 o'clock, right? Between 1 o'clock and 2 o'clock. Well, at that point, the trend is up. The trend had totally changed directions, right? Making higher highs and higher lows. The market's trading pretty much, well, at this point, pretty much trading down off the highs, right, of this last big swing up, right? And that happened near 2 o'clock. 1400 is 2 o'clock Eastern Standard Time. I'm looking for some type of move back up to retest this high. Got close to retesting it, came down a little further, and then we finally moved higher. Okay? Let's look at another example where that first the first 45 minutes is up. Look at the market opened up in here, traded down, but it's before 10 o'clock. Trades up, takes out the high, puts in this new high. Look what time it is. So definitely between 10:15 right here, right? 10:15 to 10:45. We're expecting some type of counter trend move, some type of move against the trend, right? The trend up until that point was up. So we're expecting a movement down. And a lot of times, the market completely reverses in and around that time. Market came close. Market came all the way down and tried to retest the low of the day and failed, but we did, market made a big counter trend move down off that high. Okay? So look at this time. The market here, it's trading between 1, right? 1300 is 1 o'clock Eastern Standard Time, and 1400 is 2 o'clock. So the high of the day up until that point was right here. The market's trading down off the high of the day. It hits a support level in between that time, right? Between 1 o'clock and 2 o'clock Eastern Standard Time, you're looking for some type of resumption. The market did run up, came down a little further, and then resumed for the remainder of the day. And that's really what I'm expecting. And these times provide absolutely fantastic trading opportunities. I know people that make a living just focusing their trading around these times. All right, let's talk about the 2 and the 3 o'clock moves. All right, let's talk quickly about the afternoon move. I call it the afternoon move. That's in and around, give or take 15 minutes, 2 o'clock Eastern Standard Time, okay? I'm expecting either, number one, a resumption of the day's trend if no move after 1 o'clock. So if you don't get that 1 o'clock post-lunch move, you're expecting it in and around 2 o'clock, okay? Or expect a counter trend move of the day's trend if the market must be testing the high or the low of the day depending on the trend up until that point, right? So at 2 o'clock, if the trend is up and the market is actually testing that high, I would expect a counter trend move, which means, again, a movement down off that high of the day. If, on the other hand, the trend is down and the market is actually testing that low, I would expect some type of move to the upside, a counter trend move to the upside, right? And the last time of the day is what I call the delayed afternoon move right here. The delayed afternoon move, that's about 3 o'clock Eastern Standard Time, right? So again, what dictates this is the 2 o'clock move. So the 2 o'clock dictates what happens at 3. So you're either expecting, number one, a counter trend move off of the day's trend, if the market is testing the high or the low, right? So you're expecting a counter trend move if the market is testing the high or the low. Or a resumption, right? A resumption of the day's trend. If a counter trend move occurs in and around 2 o'clock, it'll typically take the market down off the highs to a logical support level where you'd logically expect a resumption back up towards that high of the day, right? So let's look at this again. And it'll become clear once you take a look at charts. So again, the 2 o'clock move dictates what happens at 3 o'clock. So you're expecting either a counter trend move of the day's trend if the market is testing the high or the low, right? It's that simple. Or number two, you would expect a resumption of the day's trend if a counter trend move occurs around 2 and the market is trading down off the high of the day in an uptrend, right? or up off the low of the day in a downtrend. So I think what's better here is to take a look at a chart to show you exactly what I'm talking about. Look at this. In and around 2 o'clock, right? 1400 is 2 o'clock. This shaded area represents the 145 to 215. Somewhere in that zone, you're expecting a counter trend. Now, what do you suppose the trend of the day is? Well, if the low is here, the market's been trending up. This is the actual high in and around 2 o'clock. What are we expecting? A counter trend move or a resumption. It depends on where the market is. Well, at this point, I would expect a counter trend move because it's on the high of the day, testing this high over here. I would expect a move to the downside. See this red down arrow? Well, it did exactly that. The market made a counter trend move, hit a support level right in here, right? Remember, 1500 is 3 o'clock Eastern Standard Time. So 2 o'clock, we got the counter trend move to the downside. 3 o'clock set up beautifully for the resumption of the day's trend, right? Hit a support level right here. And a resumption would simply mean the market starts to bounce up, like you see in the green arrow here. It bounces up to retest and take out that high. That's all I'm trying to get across these times. Very key. Okay, let's take a look at another chart quickly here. Obviously, what is the trend? Trend's down, right? Market opened up here, traded down, down, until, look at this, 2 o'clock, right? 1400 to 2 o'clock. Between 145 and 215, you would expect some type of counter trend move to occur. Well, did it? Well, it sure did. It bottomed out here, made a counter trend move up in here, came down, came up. Let's just jump back a little bit. Let's go. Remember our first time, the morning move from 10:15 to 10:45? That'd be right in here. 10:15 to 10:45. What are we expecting? A counter trend move. Well, look at this. It bottomed out. Well, actually, it came down, made a new low at about almost 10:30. Isn't that one of our times, our first time? So the trend is obviously down. Market moves from this high down to this low. It's at one of our times between 10:15 and 10:45. You would be expecting a move to the upside, a move counter to the trend, which is up. Traded up to this point and up to this point, right? Nice counter trend move before resuming all the way back down. So again, between 145 and 2 o'clock, we got that counter trend move, kind of came down. But look at what time. In and around 3 o'clock, we were still up off the low of the day, so you'd expect a counter trend move, which would be a movement to the downside. And we got it here. Didn't quite test that low, but it came real close to it. So those are the times of the day. Very, very important if you day trade or wish to day trade or to make some money during the day on a daily basis. You definitely need to understand these times of the day. Very, very important and critical. I know people, I've taught traders to make a living around these times. And so these will definitely help you in what you're trying to accomplish here. So let's move on here. All right, let's talk about simplicity versus complexity. This whole discussion really embodies the 3 everyday mistakes preventing more than 80% of traders from ever making money in the markets. This is huge. I've worked with thousands and thousands of traders, and most, I mean, you would not believe how many traders have come to me over the years and their charts look like the one here on the right here with all these indicators and fan lines, this whole analysis paralysis garbage. This is what I like to call a spaghetti chart, right? Tons of indicators. I mean, these traders are all over the place, and not surprisingly, so are their trading results. What they think will give them more clarity in their trading actually multiplies their confusion. Okay, so if the chart you're using right now even remotely resembles this, I highly, highly recommend getting rid of this junk, okay? Okay, just get rid of this junk. Clear the slate. Clear your head and start all over. I have yet to meet a trader that was consistently profitable for a significant amount of time by trading a barrel full of indicators thrown on a chart like the one you see here on the right. This is crazy. This alone, listening to what I have to say right now, will make you a better trader. I guarantee you it. And then I'm going to go into the simplicity part because it's all about simplicity. I mean, if you recall the last few slides when I was talking about the predictable times of the day, you notice that all the charts look like this, right? Just bare. There was nothing on them. Clean. Naked charts. No indicators. Nothing. Okay? This is what you need to remember. Okay? Indicators by themselves are merely tools. They will not make you a good trader. right? There's a lot more to successful trading than merely using technical indicators. Believe it or not, the simplest trading methods work the best and are the most robust, right? And that's what I'm going to show you here, right? In the remaining part of this little presentation here, okay? I mean, too many traders, especially beginners, feel that by using more indicators will help make them more successful. Or stated another way, the more complex the trading strategy, the better they'll do. That is simply not, it's simply not true. It's not the case, right? In fact, I would say it's exactly the opposite. I will prove to you throughout this entire little presentation that simple is better, okay? But don't get me wrong, okay? Don't get me wrong. There is nothing wrong with using technical indicators as long as you understand and accept that price action should come first, right? So therefore, the perfect blend is to be able to synthesize the natural ebb and flow of the market, right? Simplicity, with the use of a few carefully selected technical indicators, while knowing in which market environment to use, right? So if you know what market environment to use these technical indicators, that's the absolute critical part here, okay? Remember this, real important. The only indicator out there that doesn't lag is price. And while so many traders embark on this never-ending search for the holy grail of trading tools, it just doesn't exist. Okay? So again, if your chart remotely resembles here, the one on the right here, I suggest clearing the slate altogether. Get rid of all your oscillators at the bottom, get rid of all your fan lines, and keep it simple as possible. Because what I'm going to show you next, I think, is going to help you even more. Okay, so let's move right on into it. All right, now what I want to do is I want to show you the 4-step sequence to all successful trades. All right, real important here. Number one, you need to determine the context of the market. Okay, and I'm going to talk about this in great detail on the next video, right? The simple truth about trends. Okay, this is going to absolutely blow your mind. I'm going to get into it maybe, very briefly here, but I'll introduce you to the concept here. So number one, you need to determine the context of the market. Okay. Number two, you need to determine a valid trade setup, right? Remember this, a trade setup is not a trade entry. Okay, very important. So first, you need to determine the context of the market, right? Context of the market, I mean, is the trend up? Is it down? Is it sideways? Is it really going nowhere? Once you determine that context, you need to determine a valid trade setup. And one thing, you need to understand this, a trade setup is not a trade entry. The third step is an actual objective trade entry. So you need to enter the trade next, right? And then number four, you need to manage that trade. Managing the trade consists of where to stick that catastrophic stop, when and where to move that stop, and where to take profits. Okay? So again, the 4-step sequence to successful trades. Number one, you need to determine the context of the market. Number two, you need to determine a valid trade setup. 3, enter the trade. And 4, manage the trade, right? With, again, specific criteria for managing risk and for determining profit objectives, right? And number 3, entering the trade. You need clear and objective trading rules. Very, very important. Okay, so what I'm going to show you here can be used in any market and any time frame, okay? Not just for trading the E-mini futures contracts, okay? Any market and any time frame. Remember, and you got to remember this is very important. The more complex your trading method, the less robust it will be, which means the more complex, it's not going to work on every market. It's got to be simple. It's got to be simple so it works across all financial instruments, okay? The simpler your method, the better. Trust me on this, okay? Again, technical indicators are derived off of price action. So you need to go to the source first, and that's price action leads everything else. It's always right. Again, to successfully trade the markets, you need to understand price action. And a simple and specific trading methodology or edge, right? This is really key here. So everything I'm going to show you next, any market and any time frame, it's not just for the E-mini S&Ps. All right, the core price structure and rhythm of all markets. Okay, as you already know, there are only 3 primary waves or trends in the markets. And I'm going to go into this in great detail, wrap a lot of rules around this, and give you exact entries. So let's start off with what I'm talking about here. Again, this is the core price structure and rhythm of all markets, any market, any time frame, right? The market can only move either up, right? Higher highs and higher lows, or you get a downtrend with lower highs and lower lows, right? So again, uptrend, higher highs and higher lows. Downtrend, lower highs and lower lows. And of course, that sideways market when you have relatively equal highs and equal lows, right? The market can only move in one direction at any particular time on any time frame that you look at, right? So either got that uptrend, downtrend, or the sideways range here. And little description again here, real simple. I know it's orderly. I know it's an illustration, but I'm going to get into more detail in a minute. Again, you got higher highs here on the top left, right? Green up, right? Higher highs. And you're getting higher lows. And these lows are significant in this uptrend. In order for this uptrend to remain intact, these lows cannot be broken to the downside. Chart here on the right, you've got a series of lower highs, right? Lower highs. And you've got a series of lower lows. Pretty orderly, right? Pretty easy, pretty simplistic, pretty elementary, but most people don't really look at it this way. They've got a ton of indicators. They're looking for indicators to cross up and down, and they just get so confused in the analysis paralysis. You need to strip it all away and get back to the basics. You got that uptrend, you got the downtrend, and you got the sideways market when you have the relatively equal highs and relatively equal lows. You need to keep this in perspective. Strip it all down. Let's get back to the basics. So what I want to do here now is I want to go back, okay, to the 4-step process for boosting your trading profits almost immediately by following these, right? So again, let's look at a chart here, right? You need to first determine the context of the market, right? And so back in here, when the market broke up through these highs right in here, right, you determined that the context of the market was up because the market took out these significant highs. But when the market broke up right in here, the context of the market was up, right? So number 2, you need to determine a valid setup, right? Are you going to do some type of breakout trade? Are you going to wait for a pullback, mean reversion trading? What are you going to do? So that's what you need to determine. And then you need to determine the actual objective entry. How do you enter the market? Okay. Look at when you hit this high here and the market started coming down off that high, you're actually looking to buy that market long into a logical support level. But you need to have rules behind entering that market. You would have been long right down in here. Okay. So you need an exact entry into the market. And then once you enter that market, you need to manage that trade. Again, managing that trade consists of where do you stick that catastrophic stop? Where and when do you take profits? Do you use a trailing stop? And when do you move those stops so you're risking less than your initial entry, right? So the prior slide I spoke about is the market needs to prove itself, right? So the market needs to continue making higher highs in order for you to look to buy that market. So the market made a new high right in here and then pulled down. And you'll soon see why this was a beautiful entry to the upside, right? Market came up, made new highs here, and pulled down into a logical support level. And you would have had an entry to the long side there. But again, you need these rules. Again, you need to determine the context of the market. That's just determining whether or not the trend's up, down, or sideways. Should you be staying out? Then you need to determine a valid setup. Remember, a setup is not an entry. Okay? Once you get that entry, you need to manage that trade right. And most people don't think of it this way. Okay? So let's look at the next chart here. Okay? So again, determining the context of the market here on this chart, you'll notice, you'll see that the trend is in fact down. Okay? It's at this point when you're saying, okay, the market should continue heading lower. So once you determine the context of the market, you need to determine a valid setup, right? And in the next video, I'm going to show you what a valid setup is exactly how to enter that trade and exactly how to manage that trade. Completely objective. The more subjective you are, the worse off you are. Have you ever met a trader who got smarter while in a trade? I mean, think about that one. When you're in a trade, have you ever met anybody that got smarter? And the answer is probably not, right? You've got to have things spelled out. So the 4-step process is very significant. And again, the truth about trends, what I'm going to show and get into great detail in the next video, is going to absolutely blow your mind, okay? So again, you'd be looking to go short this market, right? You'd be looking to short any rally into logical resistance. So again, determining the context of the market, then you need to determine a valid setup. Once you determine what that setup is, the question is, do you enter that trade? Do you get triggered? Does the market do what you thought it would do? Does it get you into the market? And then once you get into that market, you need to manage the trade, and that's real important. All right, right here. Again, right in here, now look at, assuming you know nothing else, okay, right here, the market moved from low to high, and the market pulled down into a logical support level, and you'd be looking to go long. Ride it up, you make some money, but here, when the market's not able to take out this high and you kind of consolidate, it's at this point, and here you would say the trend is pretty much sideways, okay, until it busts up through the high. Remember, the higher highs and higher lows. Once the market busts up through the high of this range, that is your trigger to say, okay, the context of the market is up again, and so now I need to determine a valid setup, right? So if you're determining that the valid setup is buying on a pullback into a logical support level, then so be it, okay? But remember, a valid setup is not the same as entering the market. You need rules behind entering the market, right? Having a valid entry. So 2 and 3 are completely different. Although 2 gives you the framework for 3, and the 3 other, the number 3, entering the trade, is the specifics, the objectable trading rules, okay? And then again, when you enter that market, right, you get long, you need to manage that trade in terms of where does your catastrophic stop go? Where and when do you take profits? Do you trail up the stop? When and where do you move that initial stop so you're risking less? Right? So, all right. Does that make sense? That should all make sense, right? You need to, you need these 4 steps. You need to understand the natural ebb and flow of the market, and you know that'll make you a much better trader. Again, you can use these principles in any market in any time frame, but for pulling money out on a consistent basis, you want to be trading the futures markets. So again, we spoke about the best markets to trade, right? We talked about the 4 E-mini futures contracts, right? The ES, the E-mini S&P 500, right? The YM, right? The Dow, the NASDAQ, the NQ, and the TF, the Russell 2000. Phenomenal markets to trade. Then I spoke about the most profitable and predictable times to trade during the day that produces that daily income, and real important, what times to avoid trading altogether. And that's real important, right? And then the 3 everyday mistakes preventing more than 80% of traders from ever making money really goes with that simplicity versus complexity, that whole conversation behind wiping out all the mumbo jumbo on your charts, all the technical indicators, strip them down, go back to the basics with pure price. Remember, price action leads everything else. So once you understand price, then you can carefully select a few carefully selected indicators. But you know, once you do that, you need to know when and where to use those indicators, right? Certain market scenarios provide you to, you know, is better for you to use them at those times, right? So that's real important. And then, of course, we talked about the simple 4-step process, right? This 4-step process will help boost your trading profits almost immediately. I guarantee you, it will get you on target. Remember, you need to determine the context of the market. You need to determine a valid trade setup. You need to enter the trade, and then you need to manage that trade. Okay, and once you have those ingrained in your brain, it's going to make you a much, much better trader. All right? All right, what we're going to talk about here, first we're going to talk about two powerful price patterns, and then we're going to talk about what I like to call the simple truth about trends. Okay, before we get into that, I want to talk to you just real quickly on price action analysis. Okay, price action analysis is basically interpreting what the open, high, low, and close on a particular price bar or candlestick, whatever. You can either use a regular candlestick or a regular price bar. I learned on price bars, but I know a majority of you use candlesticks, so I'm going to be referring to candlesticks and bars, right? So again, you're going to take the open, high, low, and close, and you're going to compare those numbers to the prior price bar or candlestick because it provides incredible insight into what the market most likely is going to do next. So first you need to understand range, right? A range of a price bar basically confirms the momentum of the market, and the close confirms actual price action, right? The close tells you whether or not the bulls or bears won that day, okay? So price action analysis helps you identify insight into what the market is likely going to do next. And so I look at these patterns throughout the trading day to give me signals, all right? So let's get right into it, okay? Let's first talk about what I call the bullish, right? The bullish outside vertical bar, right? BUOVB, or of course those of you that use candlesticks like to call it the bullish engulfing pattern. Now I'm going to wrap a trade all around this, okay? I'm assuming that most of you know what an outside vertical bar is or an engulfing pattern. All that is when the high takes out the prior bar's high and the low is able to take out the prior bar low, right? That's an engulfing pattern. Okay, what makes it bullish, because we're talking about bullish setups now, what makes it bullish is if the close is in the top quarter of the price range. So over here, to the right here, on the candlestick, it closes in the top quarter. That's what makes it bullish. Okay, so I'm looking for these bullish patterns to occur at logical support in an established uptrend. Okay, and we're going to talk about the simple truth about trends very shortly, and I'm going to give you a precise definition of what I call an uptrend or a downtrend, or if the market's in a sideways range. So you're going to know exactly when to use this pattern. But again, remember, the high and low of the price bar must exceed the prior bar's high and low, right? And then it must close in the top quarter. That's what makes it bullish. And as long as this is happening when the market pulls down into a logical support level and an established uptrend, that's when I'm looking to put on a trade. So if you look over here, I am looking to buy the market either on the close of the bar or the opening of the following bar, right? This is my buy entry, okay? ISL stands for initial stop loss, your catastrophic stop loss. And that goes directly below the low of the bullish engulfing pattern, okay? Your first profit objective, right, is the range of the engulfing pattern. So you're going to take the high minus the low of the engulfing pattern itself, get the range of the price bar, and then you're going to take that range and add it to where you enter the market, and that is your profit objective. Now, I say first profit objective because you can use a whole host of profit objectives, but for this presentation, I'm going to tell you that it's 1 times the range, okay? The next pattern I look for, real quickly here, because I want to get into charts, is the inside pattern, or the bullish harami, right? Now, an inside pattern is the opposite of an outside pattern, right? The high is lower than the prior bar's high, and the low is higher than the prior bar's low. So the market is contracting, whereas the outside pattern, the engulfing pattern, the market's expanded, right? The market was able to take out the high and the low of the prior price bar. In this pattern, the market is unable to penetrate through the prior bar's high and low, so it's contracting, okay? And quite honestly, I don't care where the market closes. I don't care if it's bullish or bearish or neutral. I could care less. All I care about is if in the next few price bars, the market is able to penetrate up through the high of that inside bar, right? Now remember, we're looking for these patterns to occur at logical support level in an established uptrend, okay? Again, we're looking for the market to pull down off of a high and into a logical support level in the established uptrend. So when the market is able to penetrate up through the high of that inside bar, that's where I'm actually looking to go long. My initial catastrophic stop is placed directly below the prior price bar's low, right here. Okay, so over here to the right, inside pattern, right? The high is lower than the prior price bar's high. The low is higher than the prior price bar's low. I'm looking to go long as the market penetrates up through that high, and my initial stop is directly below the prior bar's low. All right, let's look at some. Okay, now what we're going to do is we're going to look at bearish scenarios. So we just went from the outside pattern of the engulfing pattern, right, in the support level in an established uptrend. Then we talked about the inside pattern. Now we're just going to flip it and look at bearish scenarios, right? The trend is down, right? The trend is down, and the market is bounced up to logical resistance. Remember, we're looking for these patterns to occur at logical resistance in an established downtrend, right? Market's making lower highs and lower lows, and the market finally bounces up off that low into resistance. So again, we're just reversing everything that I just showed you. So now we're talking about the bearish outside pattern or the bearish engulfing pattern, right? Again, the high is higher than the prior bar's high, and the low is lower rather than the prior bar's low, right? And it closes in the bottom quarter. Okay, here to the right is a candlestick chart, right? It closes in the bottom quarter, but notice that the low is lower than the prior bar's low, and the high is higher than the prior bar's high. It closes in the bottom quarter, and that's real important. When it closes in the bottom quarter, I'm looking to sell it at the close of that bar or the opening of the next bar, and of course, if you're day trading, it's really the same thing. Or if you want to be a little bit more conservative, wait for the market to actually penetrate down through the low of that bearish bar, right, the engulfing pattern. The initial stop loss is placed directly above the high of the bearish engulfing pattern, right, directly above the high. The first profit target is 1 times the range. So you're simply going to take the high minus the low of that pattern. Take that range, get the range, and subtract it down from your entry, and that is your first objective. Okay? It's that simple. Let's talk about that inside pattern again, okay? Again, the trend is down, and we're looking for the market to rally up into a logical resistance area. An inside pattern, right? The high is lower than the prior price bar's high, and the low is higher than the prior price bar's low, right? The market's starting to contract. We're looking for the market to rally up into a logical resistance area in an established downtrend, right? The trend is down. Market bounced up off that low into a logical resistance area. We get an inside pattern. As soon as the market takes out the low of that inside pattern, we're shorting the market. It's that simple. The first profit target here is 2 times the range. 2 times the range. So you're going to take high minus the low, right? Get that range, times it by 2, and we're going to subtract it down from our entry. It's that simple. So over here on a candlestick chart, right? Again, I don't care. It does not matter where the bar closes. All I care about is if the low and the high both are inside the prior price bar's range. That's all I care about. And then the setup itself must occur at logical resistance in the established downtrend. And then when the market penetrates down through that low, I am looking to short that market, and my initial stop loss, the ISL, is placed directly above the prior bar's high. That's where my initial stop is. Okay, the initial stop loss, the ISL, is above the prior price bar's high. Again, the profit target is 2 times the range of the inside pattern, right? Again, high of that inside pattern, the high minus the low, get that range times 2, get that number and subtract it down from the entry. It really is that simple, okay? Now, before I talk about and show you specific chart examples of those 2 price bars, right, the engulfing pattern and the inside pattern, I want to go through the simple truth about trends, right, because again, this is going to show you exactly where you're going to use these patterns, show you a bunch of examples. So again, I talked about this briefly in the last video, but again, there's only 3 primary waves, right, or trends in the markets, right? You've got the uptrend, right, and that's simply higher highs and higher lows. Or, of course, you've got the opposite, which is a downtrend, right? You got lower highs and lower lows. And then, of course, if the market's not doing a whole lot, right, you're getting relatively equal highs and relatively equal lows. Okay, we've all heard of this. It's pretty simple. It's pretty basic and elementary. But again, like I talked about in the last video, you know, the simplicity versus complexity. Most people's charts look like vanilla, looks like spaghetti, right? You got tons of indicators all over. You need to strip those charts down, and you need to go straight to the source, and that's price action itself. So what I believe is, you know, when you identify which wave the market is in, I believe is critically vital to successful trading, right? The simple truth about trends is all about pure price action. These simple principles form the cornerstone of any consistently successful trading methodology, bar none. So let me show you exactly what I'm talking about here, right? When you have an uptrend, right, you've got higher highs, right? Higher highs, and higher lows. HL, higher low, higher low, higher low, higher low. And each one of these lows are significant. And I'm going to talk about that in a minute, right? As long as these lows remain intact and the market is not able to penetrate down through those lows, you've got to assume that the trend is up, right? So it's very basic, very, very elementary. So when you're in an uptrend, this is what we're looking for. All right. We are looking at the E-mini S&P 500. Remember on the last video, I spoke about the best markets to trade for daily income. Well, I use these principles every single day the market is open. As you can tell, the trend is up, right? The market pulls down off of a high. I'm looking for one of these price patterns to form, and as you can see right here, we've got that inside pattern right there. The market takes out this high. It might take a little while, but the market, in fact, drifted higher, continued to drift higher, and took out this high right in here. Obviously hitting all the profit objectives easily. Remember, the profit objective for that inside pattern is at least 2 times the range of that bar, and we easily got that. Took a while, but again, the market ran up and hit your profit objectives. Okay, look at here. The market makes a new high in here, pulls down, and what do you know? What do you think you got here? We got a bullish engulfing pattern here. We're looking to go long right in here. We're buying it there with an initial ISL, the initial stop loss below that low. Your profit objective is at least 1 times the range of that bar, and that was hit easily here, and it continued moving higher. So again, this is a great example of an uptrend, looking to buy in when the market pulls down into support, looking for one of the 2 price patterns that I showed you a few minutes ago. Here's another chart, and again, this chart, well, look at this chart. All right, this chart is the candlestick. This is a regular bar chart, and you can see these price patterns here. Again, the trend was up in here, right? Hit a high. I mean, you'll notice that these charts are pretty plain vanilla, right? There's no technical indicators. There's nothing fancy or complicated on these charts. I'm simply looking for higher highs and higher lows, and I'm looking for the market to pull back into logical support levels combined with one of the 2 price patterns. And you'll see that the market came down off this high into a logical support level. Look at this, created this inside pattern right here. You notice that the high is lower than the prior price bar's high. The low is higher than the prior price bar's low. Took it out right here. The risk is very small. Your initial stop loss, ISL, is below that low, and your profit objectives are easily hit to the upside and then some. You'll notice that the market opens up higher the next day here. Obviously, the trend is up, continuous, right? Right? The market hits a high right out of the gate, starts to pull down off that high, into logical support. Look at this. This is an outside vertical bar, or you can call that a bullish engulfing pattern for those of you that prefer to use candlesticks. Look at that. Took out the low of the prior price bar, took out the high of the prior price bar, closed in the top quarter, and as you can see, the market ran up and tested the high of the day, profit objective, and then some hit to the upside. Just beautiful. Okay, I can show you these examples all day long. Let's look at a downtrend now. Let's look at some examples. You all know what a downtrend is, right? You're making lower highs, right? LH, LH, LH just simply stands for lower high, and lower lows, right? Lower lows. Every time the market is able to take out the prior price bar's low, that just further confirms that the trend is down, right? Lower lows and lower highs. So every time the market pulls up into a resistance area, you're looking to sell this market with a price pattern, right? So you'll notice on this first illustration, that's an inside pattern, right? The high is lower than the prior price bar's high. The low is higher than the low of the prior price bar, takes out that low, takes it out, continues to move lower. You know, this is an outside pattern or a bearish engulfing pattern right here. Continues lower. All right, let's look at some examples here now. Take a look at this. Take a look at this. Market trend is down. Market opens up, makes a high, falls down to this low. Now, if you recall, what do I say? Between 10:15 and 10:45, right? This is 10:30 right here. You're looking for some type of counter trend move to the overall trend. The trend of the day is down at that point. Hits our predictable time, right? Our profitable and predictable time of the day between 10:15 and 10:45. Market reverses, starts to move up, counter to that trend. Look at this inside vertical bar right here, the inside pattern right here. Takes out this low, a couple bars later, drops down to this level in here. Hits the profit target that I talked about earlier. And again, all you do is you take the range of that inside pattern times 2 and subtract it down from your entry. Profit objective easily hit here. Then it rallies up even further and creates, what does that create? Look at that. That's an outside vertical bar, right? Takes out the high of the prior price bar and the low of the prior price bar, closes in the bottom quarter. And what do you suppose happens? The market drops exactly as you would anticipate for the market, right? Market takes out the low, continues its trend to the downside, pulls up, pulls down, kind of consolidating a little bit in here, but then creates that inside pattern. Again, we're at resistance here, right? The overall trend is down. You're still at resistance. You're testing the prior high. You have that inside pattern here. It takes out the low of that inside pattern, hits at least 2 times the range of that inside pattern before moving up higher here. So again, 3 nice trades in this day, right? From it opens up here, opens up right in here, closes here. You had 1, 2, 3 nice trades based on those patterns and the simple truth about trends. Look at the market opens up the next day here, puts in a low, rallies up into a resistance area because this becomes a lower high, right? When the low of the day is taken out on the open here, rallies up into some resistance. You get a tight little inside pattern. You see this little bar right in here. Takes out that low. You go short with the stop above the high. And, of course, the market moves lower and hits your profit objective. Again, your profit objective to that inside pattern is simply 2 times the range of that inside pattern. Okay? So look at another example here. Again, this chart is pure price bars, no candlesticks. So again, look at the trend is down, hits the low, rallies up. What do you suppose you have right here? This is an inside pattern, right? Or an outside rather. Takes out the high of the prior price bar, takes out the low of the prior price bar. Looking to go short right there on the close. Your initial stop loss is above the high. And let's just take this off. And as you can see, the market comes down a little bit. You see a little loser there, right? The market came up and takes out the high, fakes us out. That's a little losing trade, no big deal. Market comes down, officially takes out this low, make a lower low right here, rallies up. Then you've got this inside vertical bar right here, takes out that low, goes short, profit objective, and then some hit to the downside there. Market closes, opens up, right? Opens up into resistance. Again, remember, this is the overall downtrend here to this low here, opens up. And if, right? And look at what sets up right in here. You have an inside pattern right there, right? A lower high and a higher low. Takes out that low right there. All profit objectives, and then some hit to the downside. Remember, your initial catastrophe stop loss is above the high, never hit. Makes a new low here on the day. Look at what happens. Look what time it is, 10:30. We're looking for some type of counter trend move, right? The trend of the day is down, and the overall trend is down as well. Well, we're expecting some type of turn up in price. We're looking for a counter trend move or some move against the trend. We got that, right? And then it hits resistance. And check, look at this. You have an inside pattern here, right? Lower high and higher low. Takes out the low. That is a sell. And the market definitely moves down and hits your profit objectives and then some to the downside. Okay? Now, not even talking about the two powerful price patterns trading against the trend, right? Counter trend trades. Haven't even touched upon that, okay? But if you were to look for some type of counter trend trades on retests of lows, look, you hit a little low right here. You have an inside vertical bar, rally up, come down. We retest that low, and then look at that. That's an outside pattern, right? Takes out the low and the high of the prior price bar, and you get the move up. Look at that, up, move up. That's not even trading with the trend. It's trading counter trend, right? A little something extra for you there. The market pops up. But again, you need to look at these patterns and you need to concentrate on these patterns when trading with the overall trend on an intraday basis when day trading, okay? Let's talk about that third scenario and the simple truth about trends, and that's the sideways market, right? So the reason I touched upon possible counter trend moves is because in a sideways market there are moments where you can take advantage of, selling a retest of a high or buying a retest of a low. Okay, so again, a sideways market is simply when you're making relatively equal highs and relatively equal lows and the market's really not trending, right? You're pretty much failing at tops and you're failing at bottoms. Unfortunately, you really don't know this pattern until you're about halfway to 3/4 through before you break up or down. Okay, so let me look at show you some charts here. Now remember, whenever you enter into a trading range, the market first must be coming out of it must be trending up or down first. Well, as you can see, the market's in an uptrend, right? Market makes a move, right? Puts in this high, then makes a new high, and then makes a new high yet again. Okay? Or if you want some indication that the market might pull back, right? Look at the top there, that red arrow right there. That's a bearish outside vertical bar, this red bar right here. Took out the high and the low of the prior price bar. And in fact, if you had shorted that, looking for a top to be put in place, using that particular price pattern, the market did come down and did exactly what you thought it would do, and that's to pretty much retest the prior two lows in there, okay? Again, that's counter trend, right? But it is a price pattern near that high, and it called that turn right in here. Then it popped up and made a new high, right? So the trend, you could say that the trend is still up. So now when the market starts pulling down off that high, we're looking for a reason to go long. So we're looking for a price pattern. If you see, look at this green arrow right in here, you have an inside pattern right here at a support level. The support level being testing these prior lows, right? So you have an inside pattern here, and it took it out on that third bar after it was formed right there. On this price bar right there, that was the long trade. And as you can see, once you took out that high of that first inside vertical bar down into a logical support level, right, in an overall uptrend, although the last couple hours we're in a trading range, right? We're in a range right in here, but in the midst of an overall uptrend. So once the market took out the high of that inside pattern, as you can see right in this movement up in here, your first profit target, right, profit objective number 1 was hit. And what is that? That is 2 times the range of that inside pattern. So that was easily hit to the upside right in here. Okay? Now, in here is the opposite scenario, right? The overall trend is down, isn't it? Market moved from this high down to this low, right? So now you come down, pull up into resistance, you come down, make a new low, up, down, up. We're at a logical resistance area here in an overall downtrend. So we're looking for a price pattern, one of the 2 price patterns, and you see it right in here. You see the inside pattern right in here, right? The high is lower than the prior price bar's high. The low is higher than the prior price bar's low. It took it out the very next bar, combined with an outside pattern here. And as you can see, all the price profit objectives were hit to the downside, right? Remember, the profit objective of the inside pattern is 2 times the range, right? Now that's just one, right? You can use your own profit targets, but I just gave you one profit objective there. Now look at this one. Again, back to counter trend trading, right? Against the overall trend, okay? Market puts in a low here, retests that low, comes up off that low, comes down, retests these 2 lows one more time. Look at that. Takes it out marginally, followed by an inside pattern, right? Look at the high. The high here is lower than the prior price bar's high. The low is higher than the prior price bar's low. If you want a very low risk trade, you go long as that high is broken to the upside right here with an initial stop loss directly below the lowest low. And look, as you can see, the market ran up beautifully. And again, beautiful way for producing daily income on the E-mini futures contracts. Beautiful, 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 right? Now, let's talk about an uptrend reversing into a downtrend, right? What we need to see here is we need to see a downside penetration of the most recent higher low. Now remember, in an uptrend, we have higher highs, right? We have higher highs and higher lows. HL, right? The most recent higher low is what we want to be concerned with this uptrend. So when the market is able to penetrate down through the highest low in that uptrend, we're assuming that the trend is changing from up to down. So once we get that penetration right in here, right, we're assuming that the trend is changing from up to down. So when the market rallies up into a logical resistance area, we're looking to go short the market. We're looking for one of our patterns to form and then go short, okay? So again, this is to show you that an uptrend potentially reversing into a downtrend with the downside penetration of the most recent highest low, which is at this point here. See that? So once that's penetrated to the downside, we're assuming the trend has changed from up to down. Now we're looking to sell the market into a logical resistance level using those 2 powerful price patterns. Okay, let's take a look at this. All right, look at this chart. Obviously the trend is up, right? Look at this. Market's really moving to the upside. Some beautiful trades. I mean, look on the way up. Look at this. Look at that inside pattern right here. Takes out the high right there. Initial stop loss down in here, never taken out. Takes out that high, and the market runs up. Puts a new high, pulls down, right? Makes a new high again, the highest high, the HH on this chart, right? The market starts to consolidate, doesn't do much. But once the market penetrates down through the most recent highest low right here on this blue line, once it penetrates down right in here, we're assuming that the trend has changed from up to down now. So now we're looking for any reason to be looking to short the market. So rallies up a little, doesn't give us a pattern, drops down to this new low, we'll call it NL, new low, rallies up. Look at this inside pattern right here. Look at that. High is lower than the prior price bar's high. The low is higher than the prior price bar's low. It penetrates down through that low right in here, and nice trade to the downside there. Beautiful, beautiful, beautiful trade to the downside. Let's take a look at another example here. Right, the trend is up. The trend is obviously up. Right, hits this high here, pulls down into logical support. Look at this, creates a little inside pattern here. Takes out the high. Go long there. Profit objective sit to the upside, makes a new high again. Comes down looking for a price pattern. We don't get it, but instead the market drops down. Penetrates down through the HL, the highest low in the prior uptrend. So when the market penetrates down through that high HL, the most recent highest low right in here, we are looking for any reason to be selling the market short. The market closes, opens up lower. But we know that on the rally up, we want to be selling the market into a logical resistance level combined with a powerful price pattern. And as you'll see right here, we have an inside pattern, right? The high is lower than the prior price bar's high. The low is higher than the prior price bar's low. it penetrates down through it, and as you can see, the market drops beautifully to the downside, and all your profit objectives easily hit to the downside, okay? Now let's change it up a little bit. We're going to reverse it. So we're going to talk about an established downtrend, right? A downtrend reversing into an uptrend, right? So we're looking for an upside penetration of the most recent highest low. So in this downtrend, we get lower highs, right? Lower highs and lower lows, right? Lower lows, right? Simple downtrend, right? As long as we're able to make lower lows and lower highs, we're in a downtrend. So when the market is able to penetrate up through the most recent high, which is done right in here, we're assuming that the trend has changed from down to up. So now when the market starts to pull down, we're looking for a reason to be buying the market long. So we're looking for the market to pull down off the high into a logical support level, combined with one of the two powerful price patterns that I showed you, right? The inside or the outside pattern. It's that simple. So again, the downtrend, right? The downtrend potentially reversing into an uptrend with the upside penetration of the most recent high, right? The lowest high in that downtrend. So let's take a look here. All right, on this chart, market opens up, it rallies up. Obviously, the trend is up at that time. We're waiting for the market to pull back. The market pulls back. Really, we created a little tight little inside pattern here. Busts up through it, runs up to here. The stop on that I would use below the lowest pullback there, right in there. Market kind of pretty much consolidates. You see a bullish outside vertical bar here, a bullish engulfing pattern, a bullish engulfing pattern. Never taking out that initial low. So basically what we had is three price patterns at a logical support level and an established uptrend, right? We had the established uptrend, right? Market hit that high, pulled down, and then really started to consolidate in here. And these three green circles, oval shapes, you had three price patterns, and the market eventually really rallied up, as you can see here, and did exactly what we thought it would do, and that is the market coming back up and trying to retest that high, which it did. It came up, made a new high here, right? A new high NH, pulls down. There's really no price pattern in here, and then it continues moving higher. Let's look at one more example here. Look at this one, another example using a regular bar chart. Market opens up, puts in the LL, the lowest low, rallies up, takes out right to the upside, right in here, takes out the LH, the most recent lowest high, right? This is the overall trend was down. Market rallies up through the LH, the lowest high, hits the HH, we call it highest high. Trend is up at that point. Market pulls down off that high into a logical support level, and look at that. That is a bullish engulfing pattern or bullish outside vertical bar. It closes in the top quarter, right? The high takes out the prior bar's high, the low takes out the prior bar's low, and continues moving higher. Makes a new high here, pulls down into a logical support level. Look at that. We create an inside pattern, right? Tight little inside pattern, takes out that high 2 bars later, and the market goes up again. Takes out the high right here again. Pulls down, inside pattern. Market finally takes out that high right in here, and the market comes up. All right, hits a new high here, pulls down into a logical support level, creates an inside pattern right here, and finally takes it out here. All profit objectives on all 4 of these trades are easily hit to the upside. So you had one trade here, the second one right there, third and fourth. Why make it any more complicated than what I'm showing you? The trend is up. The market's proven itself by making higher highs and higher lows. Every time the market pulls down off of a new high into a logical support level, we're simply waiting for either that inside pattern to occur or the engulfing pattern. In an uptrend, we're looking for the bullish engulfing pattern or the bullish outside vertical bar. It's that simple. A great way to earn the daily income. Again, everything that I'm showing you can be utilized really in any market, in any time frame, okay? So let's recap this. The 2 powerful price patterns at logical support in an established uptrend. Remember, what's important here is we need to see these 2 patterns. We need to see these 2 patterns at a logical support in an established uptrend. And we've already defined what an uptrend is, right? Making higher highs and higher lows according to the simple truth about trends. So when that market pulls down off that high into a logical support level, we're looking for either the engulfing pattern, right? The bullish engulfing pattern right here, right? Bullish outside vertical bar or the bullish engulfing pattern. Again, it's defined as the current price bar takes out the prior price bar's high and takes out the prior price bar's low, and it must close in the top quarter. Okay, must close in the top quarter. Okay, that initial stop loss, the ISL, goes directly below the low of the bullish bar, the bullish outside vertical bar or bullish engulfing. And the profit objective, the first profit objective is simply 1 times the range. It's that simple. Okay? This is for buys in an established uptrend. The second pattern is the opposite, right? It's an inside pattern. The high is lower than the prior price bar's high, and the low is higher than the prior price bar's low. I don't care where it closes. I could care less. All I care about is if and when the market penetrates up through the high of that inside pattern, I'm going long. The initial stop loss, the ISL, the catastrophic stop loss, is below the prior price bar's low, or the lowest low up until that point on the pullback, okay? So whether you use regular bar charts, right, the inside vertical bar, or the bullish Harami. Again, I don't care if it's bullish. I just care if it's inside. If it's contained within the prior price bar's range and the market is in an uptrend and we bust and the market penetrates up through the high, I'm looking to go long with the stop loss directly below the lowest low up until that point of the prior price bar. It's that simple. So those are the two bullish price patterns. Again, let's reverse it, right? The trend is down. Right, the market's making lower lows and lower highs, and the market's pulling up off the lows. We're looking for, right, the market to pull up into logical resistance in an established downtrend, right? So if the market pulls up and we create a bearish outside pattern, right, the market takes out the high and the low of the prior price bar and closes in the bottom quarter, I am shorting that market, right? I'm going short. The initial stop loss is directly above that high. It's that simple. That's simple, folks. And the first profit target is simply 1 times the range of that price bar. That's simple. Or you can take half the range from where you're selling it to the lowest low. So if this is the low down in here and you're selling it up in here, you take half the range from where you go short to this low, the distance, and then split it in half. So it's really the 50% retracement back to the low. Okay? The second pattern right here is the opposite of an engulfing pattern. It's that inside pattern, right? The high is lower than the prior price bar's high, and the low is higher than the prior price bar's low. It's inside. I don't care where it closes. All I care about is if the market penetrates down through the low. Once it penetrates down through the low of that pattern, I am short. The initial stop loss, the catastrophe stop loss, is above the high of the prior price bar or the highest high up until that point in that downtrend, okay? It's that simple. The profit objective on this is simply 2 times the range of that little tiny inside pattern, or, of course, the halfway distance back to the low that the market pulled down off of. Okay, so let's say this is the low down in here. We're shorting it right up in here. We're selling it. So you're going to take your sell entry minus the lowest low that it came down off of, divide it by 2, get that number, and a profit objective could be halfway back to this low. It is that simple, okay? So if you've got any questions, please let me know. But I think this is, we talked about the 2 powerful price patterns, the inside pattern and the outside pattern. We talked about the simple truth about trends, trying to make it as simple as possible for you to pull money out of the market on a daily basis. All right, let's jump right into the 30-minute breakout strategy, okay? Now, once the market moves, in either direction off the open and penetrates up through the high or down through the low of the first 30-minute range, we're looking for the first 30-minute range here, we're going to assume that a new trend potentially begins in the direction of the penetration, okay? So let's make it real simple. Let's look at the buy entries, okay? If the highest high of the first 30 minutes is penetrated, then I'm looking to use a buy stop order to enter long as it penetrates up through the high of the first 30 minutes, okay? A sell entry, just the opposite. If the lowest low of the first 30 minutes is penetrated, I'm looking to use a sell stop order to enter the market short automatically as that low is penetrated. It's that simple. Let's look at an illustration right here. So, however that first half hour is formed, it really doesn't matter. Remember, the market opens at 9:30 a.m. Eastern Standard Time, okay? 9:30 a.m. Eastern Standard Time. So you're simply sitting there and you're waiting for that first half hour. So if you use a 3-minute chart, you'd be looking at the first 10 minutes, right? So as soon as it hits 10 o'clock Eastern Standard Time, which is this bar right in here, you're going to simply bracket the market, right? You can have a buy stop above the high and or a sell stop below the low, whichever is taken out first. So this one on the right is the buy scenario, right? Right here. The market penetrates up through the high of the first half hour's range, you're looking to go long. Okay? The opposite is true to the illustration on the right. Okay? The market opens up at 9:30. Just trading around. You're looking for that first half hour range to be put in place. You got the high and you've got the low of the first half hour. In this particular example here, the market breaks down through the low. So you'd be looking to go short as that low is penetrated to the downside. Again, real simple. You're sitting and watching that first half hour. Once you get that half hour range, you're looking to either buy up through the high of that range or sell down through the low of the range, okay? Little caveat, there's a couple caveats here, okay? I do not enter with a buy stop or sell stop on rounds or halves, but rather when trading the E-mini S&P 500, right, one tick above around 00 would be 0.25, right? So I'd be looking to buy it on either 25s or 75s, right, and sell it at 25s or 75s. Again, I am not entering the market automatically using a buy stop or a sell stop when entering this position on rounds or halves. A round is a 00 and halves is 0.50. So I adjust that entry either above or below, depending on if I'm looking to short it or buy the market, okay? Now, there's a few things that I need to discuss with you to make this even a higher probability type of trade, okay? So coming into a new trading day, right? So coming into a new trading day, now that you completely understand the basic entry, right? We just talked about the entry of the 30-minute breakout, right? It's imperative to discuss how we view the price action for the first 1 hour, right? From 9:30 a.m. Eastern to 10:30 Eastern, so that we can stack the probabilities in our favor before we take a trade, okay? So as you've already learned, right, the simple truth about trends is based on the upside penetration of market highs and the downside penetration of market lows, right? The simple truth about trends. So when coming into a new trading day, I suggest using yesterday's price action and continue the trend from the prior day for at least the first hour of trading, okay? So let me get, you'll see what I mean when I start showing you some charts here, okay? So in order to begin the trend on an intraday basis, I suggest using the range of the first half hour, right? So I call this the 30-minute range, the first 30-minute range. Okay, let's go on here. So again, the first 30-minute range, it's from 9:30 a.m. Eastern to 10 o'clock Eastern, right? This is important, okay? The first half hour helps set the tone of the day, okay? It really does help set the tone of the day. I think the first half hour can be pretty unpredictable, you know? So I like to sit there and watch for that first half hour, and then, you know, this strategy helps set the tone for the day. So the first 30 minutes to 1 hour, I can even take that up to 1 hour, helps set the tone of the day, right? Therefore, I mean, look at during the first half hour of trading, I typically, majority of the time, I sit, watch, and just wait, okay, for that range to be put into place, and then I wait for the market to either break up through the high or down through the low. So if the market penetrates up through the high of the first 30 minutes, all right, when you continue the trend from the prior day, so if the market is in an uptrend from the prior day, okay, so coming into the new day, if the trend is up, then I assume the upside penetration of the high of the first half hour is the continuation of the trend, and I trade the first 30-minute breakout strategy, okay? So again, if the trend of the day coming into the day from the prior day is up, then I assume when the market penetrates up through that high of the first 30 minutes, I'm looking to take that trade, okay? On the other hand, if the market is in a downtrend, right? If the market's in a downtrend, then continue to sit, watch, and wait for the market to confirm an uptrend. So if the market's in a downtrend from the prior day, right, and it opens up in the first half hours kind of down to sideways and it breaks up through the high, then I'm a little less prone to buy that market since the trend of the day carried over from the prior day is down. Follow me? And again, after this, I'm going to show you some charts so you fully understand, okay? So if the market penetrates down through the low of the first 30 minutes, when you continue the trend from the prior day, if the market is in a downtrend from the prior day, then I assume the downside penetration of the low of the first 30 minutes is a continuation of the downtrend, right? And so in that case, I trade the 30-minute breakout strategy. I want to be trading in the direction of the trend carried over from the prior day, okay? On the other side of the spectrum, if the market is in an uptrend from the prior day, then I continue to sit, watch, and wait for the market to confirm an actual downtrend before acting on this, okay? So let me show you exactly what I'm talking about here. All right, take a look at this example, okay? This is yesterday, right? The trend was down, right? The trend was down. Market closed right here. Okay, this is the lowest high from the prior day, right? This is a significant high. That's simple truth about trends, right? We're looking for lower lows and lower highs. So this LH stands for the most recent lower high. Look at the market opens up and penetrates immediately. It penetrates up through that lower high. See these two vertical bars, these two vertical lines here? That represents the first half hour of trading. And this horizontal line right here represents the high. The market took out that high, and the trend overall is up because we took out the lower high from the prior day. In that particular scenario, I would definitely be looking to buy it based on the first half hour breakout strategy, right? Based on the rules that I showed you on this first slide, right? So as the market broke up through the high of the first half hour, I am long the market. Okay, does that make sense? So again, the market will most likely continue higher if an upside breakout occurs of the first half hour initial range when continuation of the trend from the prior day is in an uptrend, right? So even though the prior day was in a downtrend, the market on the opening took out that lower high, the most recent lower high right here, took it out. So that changed officially from a downtrend to an uptrend, right? So take a look at the market ran up, created this high here, came down, right? Came down to a support level right here. And if you remember, I showed you two powerful price patterns, right? The outside or the engulfing pattern and the inside pattern. Well, what do you suppose you saw right here? That's an inside pattern right there, right? You see that? Market took out the high of that inside bar, right? The market ran up. That was a great trade based on the two powerful price patterns, right? Market pulled down from this high into a logical support level, right? And then bounced as soon as the market penetrated up through the high of that inside par. Made a new high here, pulled down into support. Look at this inside pattern right here, right? The high is lower than the prior bar's high. The low is higher than the prior bar's low. Penetrated that high to the upside and ran up again. Not too bad, right? So a little review there. Okay. Now on this chart, you'll notice that the prior day is down. Big time, right? The market closed here and then opened up lower. So the overall trend is actually down here. Again, these two vertical lines represent the first half hour. This is the first half hour's high, and this is the first half hour's low. Now, of course, in hindsight, buying it up through that high would have been a great deal. You would have made money there. Now, am I saying that I never buy in the direction of a non-trend, meaning in this particular case, buying it up through the high of the first half hour went against the overall trend from the prior day. I do take trades occasionally against the trend, especially if there's enough room between a logical resistance area. So in this chart, as the market's breaking up through that high, whatever you deem as resistance, if you've got enough room between where you're buying the market and your first resistance level, I would in fact take the trade. But in a case like this where you're actually going against the trend from the prior day, right? Again, we're going against this overall. See this line I'm drawing, right? The overall trend is down. Okay, so if I'm going against that trend and I'm buying the market as it takes out that high, my stops are going to be much, much tighter and closer, right, than if I am trading with the trend. So in a case like this where I bought the market long on this bar, if I went long, my initial catastrophe stop would be directly below the low of the bar that got me long. And then I would continue trailing that sell stop up to lock in profits. Okay, make sense? So let's flip it around to the other side. Okay, we got another example here. Okay, we've got a few more examples. Good. Again, look at this. Trend was up, hit the highest high of the day, came down, closed lower, took out this higher low here, opened up even lower, right here, opened up lower, and continued down to this low. So obviously the trend is down, right? The trend is down, right? Carried over from the prior day. First half hour, right? You got the high of the first half hour and the low of the first half hour here. And as you can see, look at this. The market took out that low and you would be short. Again, let me read this to you. See, the market will most likely continue lower if a downside breakout occurs of the first half hour at the initial range when continuation of the trend from the prior day, right? So the prior day, it turned lower by closing lower right here, and then it continued lower on the open and continued down. So when we got this breakout, that was a textbook trade setup to go short that market. Okay, let's take a look at another example. In this particular example, look at this. See, in this particular example, the prior day was down, right? The market made the high here, closed right in here, made lower highs and lower lows right in here, right? The thing that threw us off a little bit here was the market gapped up significantly. So technically, the trend changed from down to up because it gapped higher. But as I'm going to talk about in a second, if you get a big gap and you get that initial first half hour range, which you got here, right? The high of the first half hour, the low of the first half hour is right here. And so looking to short this market below the low, as long as there's enough room between where you short the market and fill in that gap, then in fact I would say yes, go ahead and sell that. Okay, but in a situation where there's not enough room between taking out that low and filling the gap, I probably would not take the trade. I would not take the trade, but rather I would wait for further confirmation to take the trade. Okay. So as you can see, though, in this particular example, when the market took out the low, if you didn't feel comfortable shorting the market, automatically as it penetrated down through the low, you could have simply waited for a pullback into a logical resistance area, which would have been right up in here, right from the high of the day, high to this low right in here. Okay, so you could have been selling it in here again. Okay, and again, if you felt comfortable selling based on the first half hour breakout, you would have been short there. It gave you a little money, but then it pulled back and then continued the downtrend there. All right, so let's talk about the buy entry. So once the high of the first half hour has been penetrated to the upside, look to buy the market on a breakout, 1 to 2 ticks above the high of the first half hour. Okay, so like I spoke about earlier, you're going to be wanting to buy on 25s or 75s when talking about the E-mini S&P 500, right? The E-mini S&P 500, 25s or 75s. I do not want to buy on rounds, which is 00, or halves, which is 0.50. I don't ever want to buy or sell on those using a stop order. It's always a 25 or a 75, okay? The initial stop loss, let's talk about that because we understand how we're buying the market, right? We're simply waiting for the first half hour's range, the high and the low. Once the market takes out the high, you're looking to go long. The initial stop loss, I've got two suggestions here. ISL stands for initial stop loss. So when we're going long, the initial stop loss is placed slightly below the low of the price bar or the candlestick that penetrated up through the high of the first half hour. I'm going to show you some examples in a minute. Or placed slightly below the most recent pivot low. Okay, you'll see what I mean in a few minutes here, okay? Let me just talk about the price profit objectives real quick. We just talked about, again, like I spoke about earlier on in this little presentation here, we know where we're looking to buy the market, right? So again, we know exactly how to enter the market when going long, right? It's when the market breaks up through the high of the first half hour. Our initial stop loss, again, is below the bar that got us long or below the most recent pivot low, giving it a little bit more room to breathe, okay? Let's quickly talk about the profit objectives. I've got three very logical profit objectives, okay? The first one, just make it real simple. 1 point. Just a quick little scalp one-pointer, right? $50 in E-mini S&P 500, for example, right? That can be your first objective. The second profit objective is simply half of the range of the first half hour. So if the range of the first half hour is 5 points, half of 5 is 2.5. That would be your profit objective, right? On the second one. The third profit objective would be the entire range of the first half hour. So if the entire range of that first half hour is 5 points, then the third profit objective would be 5 points. Second profit objective would be 2.5 points, which is half of the range. And then the first profit objective, just a real, simple 1 full point. That simple. And then trailing the stop, right? Pretty simple. You just want to follow, as the market's making higher highs on each of the bars, right? Let's say you're looking at a 3-minute chart. As soon as the market takes out the high of the prior 3-minute bar, you immediately want to move that stop up to below the low of the bar that it took out the high first. So real simple. And again, a little caveat here, if any of the powerful price patterns, the two powerful price patterns that I spoke about, if you get one of those, you would immediately want to move your stop up to below that low. So if you get a engulfing pattern, right? I would want to move that stop up to below the low of the engulfing pattern if it's bullish. If you get a little inside vertical bar, again, I'd probably want to move the stop up to either below this low, or if I really want to, if I don't want to give back a whole lot of profit, I might move it up to slightly below the low of the inside vertical bar. So let's make it real simple. Let me show you some examples here. All right, look at this example. The market opens up here, right? Trades up through this high. This is the high of the first half hour, the low of the first half hour, right? Market pulls back. So we're looking to buy it as it trades up through the high of that first half hour, right? So we go long right above it, right? Again, we want to go long on either a 25 or a 75, okay? First profit target is hit right here, which is just one full point. P2 is hit right in here, which is half the range of the first half hour. So if this range of that first half hour, let's say, is 6 points, half of that's 3 points. And then profit objective number 3, as you can see, is hit right there, which is simply the full range. So high minus the low of the first half hour, get the range of the first half hour, get that number and add it to your entry, and that would project up to profit objective number 3. It's that simple. Okay? Oh, one other thing, the initial stop loss. The initial catastrophe stop loss on this particular trade would be right in here, ISL, right? You go long right on this bar right here, and your stop, you would want that below the last pivot low, either I would say that this low right in here, it moved up. When you had this little range in here, so you'd want to be below that range, because if the market breaks up through the high, like it did here, and if it reverses down and takes out that low, you want to stop yourself out immediately. okay? And as soon as the market hits your first profit objective, you're going to look to see if you can bring that stop up further if you're trading multiple contracts, okay? Let's take a look at another example here. And again, this chart is of a regular bar chart, okay? No candlesticks here. Doesn't matter, get the same results, same everything. Market opens up on this bar. This is the open. And as you can see, the market did absolutely nothing in the first half hour, right? The first 10 3-minute bars, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Look at this. This is the high of the first half hour right here, right? So I love when the market is really coiled in that first half hour and the market's doing nothing. You got a tight little sideways range. Those are great trades. As you can see, when the market busted up through the high, you're long automatically. Okay, you're long automatically on that bar. Okay, your first profit target is hit immediately, the 1 point, right? Well, since the range of that first half hour is so small, P1 and P2 happen to be the same, as you can see here. P1 and P2 are the same. P3 is simply the entire range of that first half hour, right? High minus low, get the range, get that range and add it to your entry, and it gives you the entry right there. Of course, if you continue to trail up that stop, that was a really, really, really nice move to the upside, as you can see right there. So let's take everything I've shown you and just reverse it. So we're looking for the sell entries. It's simple, all right? Same as buying, but you're looking to sell it down through the low of that first half hour. So once the low of the first half hour has been penetrated to the downside, we're looking to sell the market, right? We're looking to sell the market on a breakout on either a 25 or a 75 below the low of the first half hour's range. It's that simple. The initial stop loss needs to be placed above the high of the price bar or candlestick that penetrated down through the low of the day. It's that simple. Or you can place it slightly above the most recent pivot high. Okay? It's really up to you. Okay? But I suggest paper trading this for a while. Watch and observe this. And even more importantly, see how it helps set the tone of the day. So this concept, just the concept alone of that first half hour to hour, setting the tone for the day will make you a much better trader. Okay, much better day trader. Let's take a look at this. Again, profit objectives, real simple. Profit objective number one, just one full point. Whether 1 point on the E-minis, S&P 500 or the Nasdaq, the Dow or the Russell. It's up to you. 1 full point. The second profit objective is simply 50% of the range of that first half hour. It's that simple. Profit objective number 3 is simply the range of the first half hour. And then you're going to take that range and you're going to subtract it down from your entry. It's that simple. Okay, and again, your trailing stop, your TS trailing stop, is you can move that stop down to above the high of each price bar as the market takes out the low of the prior price bar. Okay, so let's look at some examples here. All right, take a look at this chart, right? Yesterday, the prior day, the trend was down, right? It closed right here, it opened up lower. The high of the first half hour, the low of the first half hour is put in place. Market eventually takes out that low right in here, takes it out, hits the first profit objective of a point. Second profit objective is hit immediately, which is half the range of the first half hour. And of course, the profit objective number 3 was never hit, and it just kind of continued drifting higher. All right, so real important here. Again, the trend was down, the market gapped lower, it rallied up, couldn't sustain that rally, created that range, and then finally reversed and took out that low where you wanted to be short, and the market hit 2 of the 3 profit objectives. Okay, let's take a look at another example here of a plain regular bar chart. Now this is a perfect example of going against the trend. Now it did hit the first profit target, but as you can see, the market was not able to hit your second profit target, nor did it hit your third profit target there, okay? So the trend, as you can see from the prior day, is up, right? Closed here and then even opened up higher right in here. Traded down, okay? Again, this is against the trend, so sure, it hit the first profit target, but the probabilities really are not stacked in your favor when going against the trend. I mean, you can try it, and there are times that I definitely do it, but I'm really, really close with my stop losses. I don't want to risk a whole lot. So in this particular example, if you did go short the low, as it broke down to the first half hour's range right in here, you needed your stop loss above, directly above the high of the bar that actually got you short, which was this big bar to the downside, right? So, sell stop, remember you want to be entering at 25s and 75s, not rounds or halves. Again, the market's attracted to rounds and halves, and the market turns on rounds and halves quite a bit. So that's why I like to stay away from those numbers when hiding my stops. I like to put them on the other side, right? Either with a stop loss or entering. When entering at a stop when entering at a buy stop or a sell stop, right? It's a breakout type of trade. You're not waiting for a pullback in those situations, right? You're buying through a high or selling down through the low. So again, in those situations, I like to stay away from the rounds and the halves and simply, adjust my stop to either below or above to be at 25s or 75s. It's that simple. I get that question all the time. So, all right. So again, the first half hour breakout strategy, I think it's a very simple strategy. It's very, very powerful. I definitely suggest you watch and observe this strategy before trading it live. Also take note that, again, the first half hour really helps set the tone for the entire day. Okay. Now there are days when the market penetrates either through the high or the low of that first half hour, the market continues to trend in that direction the entire day. And other times, of course, the market, might make a move in that direction once you break out and then maybe completely reverses or just does not a whole lot the remainder of the day.
All right. I think that about wraps up what I wanted to show you today. I covered a lot of ground, and I just sure hope you got a lot out of it. And again, I do apologize for going on so long, but I just had a lot of stuff I wanted to give you. Now, I would really like to recap everything for you, but I think it would take too long. So instead, we're going to send out the recording along with the PowerPoint presentation for you to review. Okay, now, how many of you would like to hear about a live trading room coupled with a coaching and mentoring program that involves everything that I've shown you here today? That will not only show you A to Z how to profitably day trade the E-mini S&P 500 futures, but is designed for you to earn while you learn. And I only allow a very small number of traders like you inside this program once, maybe twice a year at most. Most of the time this program is closed. All right, okay. I see a lot of you typing in here, okay. Practically everybody here today is type, okay, well, I see yes, sure do. All right, show me more, Todd. Okay, great. Let me be relatively brief since I've been on with you for such a long time today. Again, you can also go to the link at the bottom of this page to learn more. Okay, first off, you do not need to stare at your computer all day to day trade successfully. That's probably the biggest misconception out there. As I've shown you here in today's workshop, there are certain times of the day the market becomes incredibly predictable. And those are the times where you want to capitalize on the right trade setups. And knowing what these critical times of the day are and how to trade them correctly with the right trade setups is what really separates the winners from the losers. You see, if you're only able to carve out 1 to 2 hours a day, heck, and not even every day if you don't want to, okay, or you just can't, you can potentially earn a full-time income. And it doesn't matter whether you're a new trader or you've been trading for years. I've taught all types of traders, beginner, intermediate, and advanced, and everyone in between, how to become more consistently profitable. Okay, I now see a question from Marty. All right, thanks Marty for attending. I really do appreciate it. The question is, can I trade the E-minis if I have a full-time job? Great question. And absolutely. In fact, most of my students have jobs. Many students focus on trading an hour or two just in the morning or in the afternoon until they have more free time to trade. You see, the beautiful thing behind what I teach, and by the way, I call my mentoring program the E-mini Success Formula 2.0. Okay, see, the thing is, the methodology and trading strategies are the same strategies that can be applied to any market and in any time frame. So you're definitely not limited to only trading the E-mini futures market. You can trade weekly, daily, hourly, or even the 3-minute bars with the same strategies. You can even trade oil, gold, the Dow, or the Russell, okay? The same way you trade the E-mini S&Ps, okay? Now, your daily goal should be $150 to $250 a day per contract if you're just starting out. And thanks, Marty, for the great question. I hope that I've been able to answer it for you. All right, I'm real excited to share with you the details of the E-mini success formula combined with the live trading room. Heck, I just want to shout it from the rooftops. That's how excited I am, because I truly believe there's not another mentoring program out there that compares to what I deliver inside this program. Now, if you're like me, you not only want the best, but you want something that works and is backed up by the absolute best support available, that almost guarantees your trading success. I mean, I truly believe what I teach will help change your life and the way you trade forever. Unfortunately, at this time, I can only allow 15 serious traders like yourself inside this program to partner up with me and my team. Okay? So let me start off by describing the live trading room, because I know a lot of you want to earn while you learn. So this is a good place to start before I jump in and describe the actual E-mini Success Formula mentoring program. All right, in a quick nutshell, here's how the live trading room works. Again, click the link on this page to learn more. Now, the room is open from a little after 8 a.m. Eastern Standard Time to 12:30 p.m. Eastern Standard Time. Now, most attention is spent on the E-mini S&P 500, and we also trade the 30-year T-bond futures market. Now, you don't need any special charting software either. You'll see our charts, where to enter trades, where to place stop losses, how to manage trades, and where and when to take profits. Furthermore, we talk you through this entire process live. Each day is crammed with trading education. You hear why trades are taken and why other trades are skipped, just as if you were inside our heads. You can ask any question you want, and all your questions will be answered then and there. Now, the focus is on consistent daily profits. Drawdowns are kept small and very manageable. You can follow the trades on a small account, right? $5,000 or less. The risk is normally no more than 3 points, which equates to $150 per contract on any given trade. In a nutshell, you will gain the confidence, discipline, and patience you need to become a consistently successful day trader. This is a great opportunity to come and develop your trading skills further in a real-time setting and make money along the way. All right, I have a question from Jane, and Jane writes, how well has the live trading room performed? Great question, Jane. Now, we've got great extensive stats for you if you go to the link at the bottom of this page. There you will see an equity graph and a year-by-year summary, along with a month-by-month summary. To quickly summarize it for you right here, now the live trading room has produced 100% winning months since it opened in the fall of 2009. In fact, only 3 months have ever returned single-digit returns. Every other month for the last 7+ years have produced double-digit returns. Right now, we're averaging about a 71.8% accuracy rate with the 6-year average return per contract of roughly $2,546 per month. Okay? Now, I hope that answers your question, Jane. And remember, to get a more extensive breakdown, everybody, just click on the link at the bottom of this page. Okay, now let's quickly move on and let me briefly discuss the E-mini Success Formula 2.0 mentoring program for you. Now, to be honest, this program is like a third child to me. This is the culmination of almost 30 years of trading experience combined into one program that literally takes you from where you are right now, okay, and helps transform you into a professional trader in a very logical and methodical way, unlike anything you've ever seen before. You see, I put this program together in a pyramid format. You start from the bottom and work your way up. There are 4 levels to the pyramid that contains 27 modules. Each training module contains a PDF file and a video. No stone is left unturned. You will know exactly A to Z how I day trade. And better yet, you'll know exactly how to make money on a daily basis. You'll also have the opportunity to partner with me and my trading team of professionals if you're accepted. All right, I now see a question from Alan. Thanks for attending, Alan, and thank you for the wonderful feedback during this entire workshop, okay? You've been quite active. I really do appreciate it. And Alan writes, what if I'm new to trading the E-minis? Great question, Alan. Like I said before, this program is for all traders, ranging from total beginner to someone who is advanced and wants to further refine their skills. Truth be told, new traders typically do better with this program because they don't have any bad habits to break. Now, starting with a clean slate is an advantage for many traders. Okay, I have another question from James. And James writes, I've struggled to make a consistent daily income. Will this really work for me? Yes, absolutely, James. In addition to the lifetime personal mentoring, access to the live trading room, and access to my video vault where you can see in great detail all my daily trades and management techniques since 2002, it would be near impossible for you to fail. Look at this. I've received a rare endorsement from John Hill, who's the CEO of Futures Truth Magazine, that reads, what Todd teaches in his trading program has not only shown me a few different ways to view and analyze the markets, but he teaches a good, reliable, and straightforward trading methodology that I feel anybody wanting to learn how to trade successfully could benefit from. Okay? Now, of course, if you can't make it work for you, even with all the unlimited support, hand-holding in the room, and the mentoring program, you're protected by my 1-year, double your money back guarantee. Okay? Now, that's just how confident I am in my ability to help transform you into a better, more profitable trader. Okay? So let me quickly explain the course details a bit more, but just remember, just click the link below on this page to read more. All right, the E-mini Success Formula 2.0 mentoring program is delivered online. Okay, you get to learn from other students. You simply ask your questions directly under the module you're watching and learn from the questions others are asking, okay? You'll be able to interact with other like-minded traders like you. It's a fantastic interactive learning community. And of course, you can always call and email me at any time. Again, that's what I'm here for, okay? You also get lots of cheat sheets, checklists, and strategy guides. All of these will help you organize and understand the trading strategy so that it's both easy and mechanical in nature for you. And honestly, just this information alone is worth, what I charge for this program and a whole lot more, okay? You also get videos explaining every single training module, like I mentioned earlier. Each video explains in great detail tons of trade setups, the examples for the trades, entries, exits, and trade management examples so you can easily see how it applies to your current trading. No more guesswork. It all will be very clear and concise, and more importantly, easy for you to apply immediately, okay? And every single training module also contains a PDF, like I mentioned earlier. You also are going to have access to 8 pre-recorded webinars or workshops, right, which are archived in the members area. These will help you further accelerate your learning and the real-world application. You obviously get unlimited personal email and phone support from me. You can call me at any time, right? That's what I'm here for. I want you to succeed. And you also get unlimited access into the exclusive members area where the daily videos are located, okay? All right, now I see a question from a John, and John asks, how much money can I potentially make trading the strategies you teach inside of this program? Again, great question, John. I'm glad you asked. Again, this is another question that I've seen in the last couple hours, okay? So, again, great question, and I do appreciate you asking. So for most traders with an account size of $10,000 or more, the initial goal is between $250 to $500 a day. If you have less than 10,000, let's say 5,000 or 4,000, your goal is $125 to $250 a day. Now understand, you'll have days where you'll hit your goal, other days where you might post a loss, okay, or a break even. And there are going to be days where you exceed your goal by a lot, okay? So again, my primary objective is to teach you consistency by showing you how to make a consistent daily income using smart strategies for maximizing your profits and reducing your losses, okay? Ensuring your results remain consistent. That's real important. It's all about consistency. Now, as you increase your consistency in account size, I show you more advanced techniques for trading multiple contracts and increasing your goal even more to make even more money. Now, I hope that answered your question, John, and thanks for participating today. All right, good. All right. So again, real quickly, let me wrap this up. You not only get the access into the live trading room, but you have daily 24/7 access into a private members area where I record a 15 to 20 minute video every single trading day as if you were sitting next to me live. I walk you through each and every trade setup, bar by bar, as if you were sitting right alongside me in my office. You get to watch and learn as I explain in detail the trade setups, entries, exits, trade management, psychology, and complete thought process behind each and every trade. The complete trade sequence will be spelled out for you in an easy to understand format. Okay, you can of course watch these videos as many times as you want, and you can go into the archives and look at past videos dating all the way back to 2003. This is an extremely powerful learning tool, and the feedback from my students has always been absolutely phenomenal, to say the least, okay? And of course, the E-mini Success Formula program will teach you all the trading strategies in great detail in order to day trade the E-mini futures successfully. But these daily videos, along with being able to access a live trading room, will help you tremendously in reinforcing and expediting your learning by showing you the trading strategies in action. Now, look at this is literally priceless, and I don't believe you can find this type of extensive training anywhere else in the industry. Okay, I now see a question from Linda. Good question, Linda, and I can't believe I haven't touched upon this topic yet. Now, Linda's asking, how much does it cost to join your E-mini Success Formula mentoring program and live trading room? Now, since you're all very valued subscribers of mine, and I really do appreciate it, I'm going to give you a real special offer today that I've never given before. And all you have to do is click on the link at the bottom of this page to read more about it. I know I've really been going long today, so I'd like to wrap this up soon. And of course, if you have any more questions, please type them in the box below and I'll get back with you. Okay. Now, I see there are only 9 spots left that are available inside my E-mini Success Formula and live trading room. So, geez, we've already gotten 6 slots have been taken already. Okay, good. Okay, and again, I want to congratulate all of those. Yeah, you too, Jim. Yeah, I want to congratulate you, all of you who signed up and took your first step in partnering with me and my team here at Trading Concepts. It's really a fantastic program that will help propel you to the next level of trading success. I mean, I can pretty much guarantee you that. All right, I had a terrific time today, and I want to thank all of you that attended. I really hope you all learned a great deal from what I taught you today. And I apologize for going so long, but I really wanted to give you everything I had. Once again, if you have any further questions, please go ahead and type them in the box below, and I'll answer those for you, okay? All right, that's about it. I don't see any other questions coming in right now. And once again, this is Todd Mitchell wishing you lots and lots of success in your trading. And I really hope you're able to get in so you're able to partner up with me and my team here, okay? So thanks again for taking the time out of your busy schedules to join me today. Bye for now. Hope to hear from you soon.